about transferring your wealth, and I want to make sure you're properly educated. I have a crash course built and designed just for you. Now I'm gonna break down a 31-year-old. A 31-year-old that's married with kids, got a house, the whole shebang. And understand that not all 31-year-olds need to have this setup. Everybody's situation is different. My situation is different than yours. Yours is different from mine, and so on. So let's not think that one size fits all. It's the strategy. Now, some people believe in different strategies, and some people be like, this is the only strategy. I think that it's important for you, the customer, to make the best decision for you. Why? Because you're going to be in this relationship for years, maybe longer than you've been with your spouse, maybe over 50 years, maybe 10 years, 20 years, all these different things. So I just thought it would be important for me to break it down for you to understand. So we're going to talk about a 31-year-old who wants $1 million worth of coverage for his family. Now, you don't need to have $1 million in assets, but you have things that will need to be covered. And we're going to break that down. We have 31-year-old, $1 million, and what's the best options? And quite frankly, the best options is what's best for the client. Let's break it down. You can get something called term. Term means you can get it for a certain term or amount of time, 10, 20, 30, 40 years, and you can have insurance. But the thing about it is what happens when you outlive your term? You get a thank you letter. You can go up if you choose to renew it, but a lot of times people don't want to renew it. There are some strategies where they say buy term and invest the difference. I 100% agree with that. But the issue is people don't do it. People lazy. People got all different things going on and all this stuff. And it may not just be lazy. It just may be that they didn't get the chance to. And when you get insurance, insurance is just in case something happens. I want the insurance. I want the assurity. I want the peace of mind to make sure I'm good. And it's important that you just understand how your policy works. $1 million or $100 a month, all these different things, it's so many different ways. It's not just the surface numbers. You have to know how your policy works. But I'm gonna break down to you how each policy would work. With the term policy for a 31-year-old, it would be $74 for $1 million, and that would be a 30-year term. So TER term, $74 a month. That's not bad. If you die, if you get sick, you covered for 30 years. Now, at 31, how old will you be in 30 years? 61. So what happens after that? Well, after that, if you don't die, you're either gonna get a thank you letter or a higher bill. Now, that higher bill, okay, how much higher would it be? Let's see. If you were a 61-year-old and you wanted $1 million worth of coverage, it would be $831. So at 61, it would be $831 and 30 cents. And then you would be, and that would be for 25 years. That would be for 25 years, you would pay $831. And if you get to 80, God willing, because you want to live a long time, but if you get to 80, they're not going to insure you. Some may not. But you get in that age where you're like, you're too old. Now, granted, you're supposed to have invested the difference. So you should have other plans. That's cool. You should have bought real estate. You should have invested in businesses. You should have been doing your thing. But sometimes we don't be doing our thing. So assuming that you were doing your thing, you'd be good. Otherwise, you're just going to get a thank you letter from the company. Now, is this policy bad? Absolutely not. If you can't afford other things, get what you can get. Because there are some people who die. There are some people who might die in the first 30 years. It happens all the time. But it's just good to make sure you're protected. Fun fact, 1% of all term policies ever pay out. That doesn't mean don't buy them. That means know your situation and don't just know my situation. It doesn't matter about anything else. The only thing that matters is you being protected and you knowing how you're protected. Now, okay, you told me about the term. What's next? We got the whole life. Whole life. Now, the whole life, the thing about the whole life is you get to customize them for you. Now, Carlos, what do you mean I get to customize them? You can say, okay, this is how much I want to pay. What can I get for based off how much I want to pay? This is how much I want to get. What can I get? How much would I pay based off of how much I want to get? And then you get to also say how long you want to pay. Because just being honest, life can be good in one season and it can be different in another. And I recommend for everybody, don't pay these policies for life. I mean, you can, depending on your situation, but you don't have to. So let's just say if I chose to pay it for life, it would be $756 a month for the whole life. $756 until age 100. And that would be a month. That's not bad. It's still up there, don't get me wrong, but for the rest of your life, you're covered. And no matter what happens, you're pretty much covered. There's rules and stuff, but for the most part, it's not, it don't have to be an accident, you're covered. And that's what we want. We want peace of mind. If something happens, I'm covered. If I get sick or if I die, I'm covered. Now, you can borrow against it. Yes, that's a perk. People use the term, people like to play with words. Oh, if you borrow, then it's not really your money. The thing about it is you don't pay taxes on borrowed money. These insurance policies are instruments of the rich. They're not good or bad, but they're instruments. They're tools of the rich. And if you don't know how your tool works, then you are the tool. Don't be the tool. Let's learn and use these tools. But back to what I was saying. For life, it's $756. But if you chose to pay it for 30 years, it would be $1259. So $1259. And this will be a month for 30 years. Now, $1259, that is a little much more. Different companies charge different things for different products. You need to have an agent that's patient enough with you to make sure we find you the best coverage for your budget. And don't get me wrong, whole life will never beat the price of term. So let's set our expectations and let's be realistic with our expectations, but everybody's situation is different. So one thing I want to know when it comes to me going after money, how much does it cost me? If I'm going to pay a policy for 30 years, how much will it cost me in the long run for that $1 million? And I'll tell you, that $1 million will cost me $453K. So that million will cost me $453,000. And you're probably like, man, that's a lot. But you're doubling your money. If you look at it like that, you pay $450 and you got $1 million in case you die, and you get access to money along the way. That access to the money along the way means, what is it called? That cash value that you have at 65. At age 65, you would have CV. At age 65, you would have $500,000 that you have access to. You can borrow it, you can use it, you can do with it whatever you like. If you get sick, heart attack, cancer, stroke, that's what happens. And people will say, oh, well, what happens to this? What happens to this cash value if I die? You get $1 million. 1 million. Death. Upon death, you get $1 million. Now you paid $453, and if you died, you got $1 million, but you also got access to $500. The guy that got the term, he didn't get to borrow nothing. He should have invested. And hopefully he did. Hopefully he bought Bitcoin. But if he didn't, like so many other people who have outlived their term, because remember, I am kind of like, not to say I'm a financial professional, but I'm learning this. Many people aren't taking the time to learn their finances. I think you should. But if you're not, you're trusting and putting your trust in somebody. And we know how humans are. Sometimes they're going to do it, sometimes they're not, but they can pay a bill. So the purpose of the whole life is for the rest of your life, you just want to make sure you're covered. Kind of like set and forget. That's kind of how I look at it. Now, there are more tools and more things, and I'm going to break them down to you. But let's talk about IUL. Now, the difference between the whole life and the IUL is just supercharged and meant to grow faster, to grow your cash value faster. The IULs can be set up many different ways. Some ways work for people, some ways don't. You want to make sure you have an understanding of whose situation? Yours. Your situation. That's all that matters. So we got the whole life. Now, I went to a different company for the IUL, but let me break down this IUL. So, IUL. And there's two different types. You have a level death benefit. You have a level death benefit, which means it's going to be $1 million forever. And then you have something called, or not to say forever, it's just going to be $1 million. It's going to be level $1 million for the whole policy. And then you have something called an increasing death benefit. I'm going to break those down for you. But let's talk about this level death benefit. It's going to cost you for 30 years, $476 a month. So $476 a month for $1 million. And guess how long you're going to pay? You're going to pay for 30 years. That's not bad. That's not bad at all. It's a little higher, but at the same time, when you get past 65, he's paying way more. Way more. What happens if you outlive it? Oh, damn. It's a blessing and a curse. It's bittersweet. That's what happens. But we also want to know, if as smart investors, we want to know what? How much does it cost? So let's talk about how much does it cost. For this, it would cost you $171,000 over the course of 30 years. That would be your cost. For 30 years, it would cost you $171,000. And guess what you get from that? $1 million. Yes. If you get sick, you're covered up to $1 million. If you die, $1 million. It's pretty good. I like it. Now, they say, oh, yeah, if you die, you don't get the cash value. They say, or some policies, they say, oh, if you borrow money, it's less the death benefit. Yes, but the overall aspect is you're growing your stuff and making sure your family is protected in the long run. And if the price and the strategy works for you, that's the only person it matters. Guess what we get? Guess what we get paid to do in insurance? We get paid to sell insurance. The more expensive, the more whatever, that's the more it is. But that's not always what's best for the client. Everybody's situation is different. And that's what we need to be able to understand. But let's go over the cost, because that's what we got the cost. So let's go over what you get at age 65. So at age 65, your cash value would be $492,288. CV, $492,288. That's not bad. That's how much cash value you would have. Your death benefit, if you die, would be $1 million. That's not bad. I like that. I like that myself. $1 million. Now, guess what? If you get sick, if you have to borrow money, whatever, you have that access. It's not bad. Tax-free, like you get the money tax-free. So these are things that you want to consider when you're getting insurance. And now, a lot of people talk about this. They say, oh, well, you don't get this, you don't get that. There are policies where you get both the death benefit and the cash value, and there's policies where you don't. It's not an all-inclusive thing. That's why I don't believe you should listen to people who only sell one thing. But I'm going to show you both. Why not? So, at 31, if I'm paying for 30 years and I want both, it would cost me for the... Right. Now, the next category that we have is the increasing death benefit, and I'm going to break that down, and I'm going to break down the perks of that. So, it is also an IUL, and it is in increasing increasing death benefit. And let me break this down for you. It will be $780 a month for 30 years. $780 a month, 30 years. That's a little up there, but it still ain't that bad compared to being 65 or 61 because they're paying $830. But I digress. Let's talk about the cost over 30 years. The cost over 30 years would be $280,000 over the course of 30 years. And then let's talk about the cash value that you would have at age 65. At age 65, you would have you would have $833K. And your death benefit would be 1.8. 1.8. So let's break this down. Everybody's situation is different, but you don't want to get that thank you letter with just term because you don't want to pay $830 a month at 61. A lot of people at 61, they on fixed income. But then assuming you're just paying that $831 a month, you're still not getting cash value. The sooner you do your insurance, no matter what you get, the cheaper it will be. But a lot of people don't want to outlive their stuff. Oh, I got insurance at my job. Okay, when you leave that job, then what happens? You got to go get insurance. And you're older and your health may or may not be the same. Well, I got it with the military. Do you get living benefits? What happens if you get sick? Because it's one thing to be able to pay your policy, but if you can't pay because you got sick, then your policy lapses, then what? Then you really mess up. So these are things to consider. But how much are you paying and how much are you getting? Because when it's a 30-year pay, understand, you stop paying at 30 years. You're done. Huh, I don't have to worry about that anymore. I'm free. And you have money just growing and growing and growing and compounding. So these are definitely things to consider. And another thing that I want you to consider is this. When it comes to what's best for you, it's not up to me. It's not up to a person who only sells one thing. It's not even up to a person who sells everything. It's up to you having an understanding of what you're getting because it's your policy. So if you are wanting to know what you can get, if you are wanting to run scenarios and figure out what's the best situation for you, let me know. And here's one more gem for you. When you get done with this, put it in a trust. Put it in a trust. Have some generational wealth going on. I hear people talk about investing. But the thing that I look at it is, do you know who knows where the market's going? Traders, not sales reps. So these are things to consider.